In this lecture, we will look at how markets move. We will cover buyers and sellers, support and resistance, and pullbacks. Market movements are relatively simple to understand. There are always buyers and sellers. When there are more buyers, the market moves up and is said to be bullish. When there are more sellers, the market moves down and is said to be bearish. Here, we see more buyers than sellers, and the market rises. On the right, there are more sellers than buyers, and the market falls. When you hear the terms support and resistance, it simply refers to levels in the market where people expect there to be strong price reactions. To identify these areas, people tend to use historic price reactions for clues. An important level in the past is likely going to be watched if the market reaches that level again. Resistance is always above. The market presses up into resistance. Think of someone pressing up against the ceiling and meeting resistance. Support is always below. The market falls down into support. Think of standing on someone's shoulders to see over a wall. They are supporting you. This is the DAX on the 1 hour time frame. We can see the market pressing against resistance and falling. It is also finding support and rising. It is important to understand that support and resistance levels do not always show reactions. We simply identify these levels as the places to watch the next time the market reaches them. Support and resistance should be only one part of your trading plan. You may set alerts at important support and resistance levels, and then when or if the market reaches those levels, you start to watch and implement the next phase of your trading plan. You very often find that support, once it fails, is then used as resistance, and resistance, once it fails, is often used as support. This is again the DAX, this time on the daily time frame. We can see a level of resistance used as support once the market breaks above and comes back to that level. And now the DAX on the 4 hour time frame. Once the market breaks down below support, it comes back to test as resistance. Why do markets move this way? It's pretty simple when you get right down to it. Let's look at how and why support and resistance works. We are on the DAX on the 4 hour time frame. After the market reached this level, there were suddenly more sellers than buyers, and the market began to fall. Buyers stopped finding value at this level. They stopped buying. On top of that, buyers who had positions began to close out their positions and take their profits. They are selling their position, and this also causes the market to fall. If there are now more sellers than buyers, price begins to come down. Prices drop as people do not want to buy at this level, so price must continue to come down until the people selling find buyers. This continues as long as there are more sellers than buyers. Now at previous support, the market continues to fall. But remember, some people will buy at this point anyway, expecting the market to once again make a bullish move. They found value at this support level. At these levels, once again buyers start taking over. There are enough of them that price starts to climb. Buyers must then buy at higher levels, which continues driving the market higher. The market then reaches what was support and is now resistance. The last time the market tried to use this level as support, it failed. That means buyers didn't find value at or above this level. Perhaps they still won't. The buyers now begin to take profit at these levels after the rally higher. They want to take their profit before the market potentially sells off again. Sellers step in, expecting the move lower. Some people who bought here have held onto their position also. When the market returns to that level, which is now resistance, they close their position at break even, happy they haven't suffered a loss. Again, this helps drive the market down, creating resistance. Now, let's look at resistance becoming support and what is going on. We have now switched to the Forex pair Australian dollar US dollar, and we have also changed to the 5-minute time frame to help show that support and resistance is universal. This was determined as a level of resistance. People stopped finding value here, and the market subsequently sold off. However, the next time the market reached this level, it continued higher. It broke above the resistance area. Buyers no longer want to buy here. This would be buying the highs, right after the market has pressed through resistance. Buyers who bought at this level and held through the resistance take profits. The market begins to fall once again. Now we return to previous resistance, now support. Buyers are aware that there is now value above this level, because buyers have already bought the market above there and forced it higher. This is resistance becoming support. Buyers who missed out on the move higher now use this as a good level to buy. They are no longer buying at the highs. Sellers who sold here now get out of their positions, happy to exit at break even instead of a loss. Again, this drives the weight toward buyers. The buyers are more prominent, and the market presses higher. Look at the level being used again in the future. It is important to realize that this is how markets move. You will rarely see a market simply pressing higher without sellers stepping in. You will also very rarely see a market falling without buyers stepping in. Why is this important? Not only is support and resistance a great way to help you identify areas to watch for trades, but the market movements themselves are also very important whilst in a trade. Lots of beginners panic as soon as a market starts to move against them, and this has a detrimental impact on their profitability. Let's say you bought the DAX all the way down here. It is easy to then panic when the market begins to stall and move against you. Lots of beginners would then exit their trade. They would exit as the market starts pulling back toward their entry at one of these points. However, the market was still bullish. That is why it is important to understand how and why markets move. Selling is no different. If you sold here, but then exited through panic at the first sign of buyers, you would exit here through panic. But the market still had a long way to go. If you trade like this, exiting at the first sign of a trade moving against you, it will become extremely difficult to be a profitable trader. It is the job of your trading plan to determine where you exit trades. However, it is also very important to understand how markets move and to build the ability to remain calm when in trades. If you have the perfect trading plan, but do not follow it and instead exit as soon as a market moves against you, you are no better than someone with no trading plan at all.